Good evening, everybody. Tonight we've got the great pleasure of having Kent Savage with us. Kent specializes in the tax aspects of trading. So I'm not going to take very much of his time. I'm going to let him go right at it. Kent, welcome to the Candlestick Forum. We've got a lot of people in here very anxious to see your information.
Awesome. Well, thank you very much, Steve, for letting me be here. It's awesome to be here at the Candlestick Forum. So tonight, I want to talk about something that some people have on their minds and some people don't. Some people have had it on their minds because, taxes are going to be due soon. But I want to talk about tax when it comes to trading. And obviously, if you make a killing on your trading, you're paying a lot of taxes. If you make just a little bit of money, you're paying taxes. And if you lose money, it also affects your taxes. So taxes is something that we always have to deal with. Now, just real quick, I am a tax attorney, and I work with Traders Accounting. And we're going to go over some of the biggest things that you can do when it comes to taxes. And hopefully this will apply to a lot of those who are listening tonight. And a little bit of a spoiler alert, everybody. There's really one big thing you can do, and that's to take your trading and start to treat it as a business. So in the long run, nothing much changes on your part. You're still going to be trading just like you do in the same forums, doing the same types of things. But we can generally get better tax treatments. And so that's what we're going to be talking about today. Now, I'm going to, because I am an attorney, and Traders Accounting that I work with is an accounting firm, I do need to throw out this disclaimer. So I'm actually going to give people a few seconds to read through this. So everybody go ahead and take a look at this disclaimer. Legally, I need to give you a chance to read it. Now, the long and short, now that I've given you a chance to look at it, the long and short of the disclaimer is basically, I am an attorney, but this does not establish a lawyer-client relationship. And again, I won't spend too much time on this, as it's just a legalese. All right, so if you have questions that come up, I'm going to go ahead and have a chance to take questions at the end of this, after we get through all the slides here. So hold on to your questions and build them up, maybe write them down, and then I'm going to give you guys a chance to ask the questions at the end. I will also be giving you guys a chance to contact traders and have a chance to have a one-on-one with Raven, who's been with the company for over 10 years. And she's expert at helping people work through the business stuff. So here's some of the info. If you have questions, jot this down. Again, there's going to be plenty of chances to answer questions at the end of this. And also we'll give consultations through Traders Accounting. There'll also be a link at the end. Now, let's get on to the good stuff. Now, obviously, for you guys that are trading, you want to make money. That's why everybody's doing this. Everybody wants to make money. People spend a lot of time and a lot of money learning how to make money and working with people like Steve so that you can maximize your skills, get good at what you're doing. One of the things that you'll realize as we go through this, and like we discussed before, tax is, again, one of the biggest things that no matter how much we make, no matter how much our cash flow is, you're going to be paying a ton of money in taxes. Okay? Now, I'm going to get a little bit into the weeds because that's what tax is, getting a little bit into the weeds. but I'm going to let you guys in on a few of the secrets and one of the coolest things that you can do when it comes to trading. Now, if you are considered to be an active trader, and for those of you who don't know what that is, I'm going to talk about that in a second, what it means to be an active trader. Okay? But for those of you who are active traders, you are able to trade in a okay? If you're not an active trader, you can't. Now, you don't have to trade in a business. Most people, even if they're active traders, they will trade as just investors. Now, one of the cool things about trading is it actually is under the tax code. It's a very tax-efficient way to make money. So when you make money, you actually aren't subject to any payroll taxes, which other investments are if you're considered an active investor. But you guys aren't. So that's one of the cool things about trading already. And then on top of that, if we can trade through a business, we can get even more benefits. Now, one thing that I want to point out, in the tax code, there are a ton of deductions for businesses, and that's what we focus on. If you set up a business, then I can start taking tons of deductions. Now, back in the 1980s, back when Reagan was president, they passed what we currently have as the tax code. Now, there's been updates to the tax code, under the different presidents and different sessions of Congress. They pass different things, okay? But the main tax code that we have has been since the 1980s. And one of the main tenets of the tax code is that businesses, no matter how big or small, can take deductions. And they don't discriminate against big businesses or small businesses, okay? So we're going to get into that a little bit more on what that can mean for you. Now, a little known fact, you don't actually have to set up a business to take deductions, okay? So you can be taking business deductions and not actually have a business. So there are traders out there, and there are CPAs out there that will say, hey, go ahead, and you can trade, and you can go ahead and take the deductions that businesses would take if you have the deductions. Now, the one problem with that is under the tax reform bills that have been passed since the 80s. One of the big issues that comes up is if the IRS sees that you are taking business deductions without actually having a business, that's you waving a huge big red flag, okay? In fact, the number one group of people who are audited are people that take business deductions without actually having a business set up, okay? And when the IRS audits you, they look and see if they think you really should be taking business deductions. And if they don't think you're serious, and one of the biggest signs of being serious is whether or not you set up a company, then they're going to go ahead and classify your activity as a hobby. Now, if they classify you as a hobby, one of the problems that you run into is that the IRS will not let you take the deductions anymore. So if you're going to be playing the game where you actually do set up a business and we are going to take business deductions, it's really best to set it up and do it right by setting up a business. Okay. Now, number one thing for you guys who are listening tonight, I want you guys to find out if you guys actually qualify to be considered a business when you trade instead of just an investor. So as an active investor, there's a few different rules. Okay. Now, they're very technical, the rules, and they're very general. It's not very clear. There's been a lot of court cases out there and a lot of people who've thought about it, but here are the general rules of thumb. Okay. If you do 200 to 300 round-trip trades a year, if you spend more than 500 hours a year, that's dedicated to actively trading. Okay. And actively trading really means being logged on, looking at trades, doing the research, okay? And if you trade for 170 to 180 days at least a year. And again, this is based on some of the different IRS rulings and different things that we've seen that have come out. Again, this is very much a complex part of the law. So this is something that, again, you can call. Tell us about what you're doing to trade, and we can see if we think it will apply to you when you reach out for traders. And again, here's the number that you can reach out to and get the free 30-minute consultation. 1-800-938-9513. And again, you'll be talking to Raven. Now, if you are an active business, you should absolutely be an active trader. You should absolutely be trading as a business, because if you are, like I said, we can take a lot of deductions. Now, some of the advantages of creating a business, I've touched on some of these, but number one is we get rid of these hobby rules. If we actually create a business, you're going to get away with, you're not going to be called out for having a hobby. In other words, you're not going to get called out for taking business deductions. Like I said, the number one group of people who get audited are people that take business deductions without actually having a business. Okay. The next thing is anything that is reasonably related to your business. This includes education. This includes some other stuff that I'm going to go over in a little bit. But anything that you are actually, subscriptions, things like that, if it's reasonably related to your trading business, you can deduct it from your taxes. Okay? You can deduct enough that some people are able to, even when they make money from trading, they're able to generate a loss from their taxes. This happens every once in a while. We'll see people who are able to do this. And this gets a little more complicated, but we can even do some things, and if we take the right elections when you have a business, which we'll talk about again later, things like mark-to-market. If you take those, we can even sometimes offset the income that you make from your normal job if you have an everyday day job. So like I said, if we set up a business, we don't worry about the hobby issue, which is that IRS reclassification issue at the beginning of the slide. The second thing is the lower IRS audit rates. I told you that people who take business deductions and don't have a business are the ones who get audited more than anybody else. Well, it turns out if you actually have a business and you take business deductions, not only do you not get audited as much as the normal everyday person, so someone who just has a normal job and gets paid on a W-2, you get audited even less. So if you set up a business and you're doing things out of your business and you're taking deductions, the IRS almost never audits those people. Again, you're never audit proof, but you can be pretty aggressive when it comes to having a business. You can deduct all of those expenses that we've talked about. The losses that you have in a business, just like with your trading, it actually carries through to you, especially, well, it depends on how we set it up, but almost everybody that we talk to, your losses are going to carry through to you to create a personal loss. So it's not going to change your ability to make money or lose money like you do normally now. It's just going to make it better for you when you're taking those deductions. The very last thing that I want to point out, because I am an attorney and I kind of get geeky on this stuff, is there's an asset protection side of this too. If you set up a business, you will have some asset protection that goes along with it. I won't get in much to that, but it is a nice little advantage on the side, just in case there's ever any type of lawsuit or anything that comes your way. Now, one of the reasons why there are higher audit rates for people who take business deductions but don't have a business is because under the IRS rules, the IRS, well, you have the burden of proof to prove that your deductions were okay. So when you don't have a business, you actually have the burden of proof to show to the IRS that you deserve those deductions. So that's why the IRS goes over people. And that's what this little rule here that I have. This is from the tax regs and also from a case that came out of the tax court. Basically, you have to retain records in everything we do so that you can prove that you're entitled to all the types of deductions and credits and anything else that we take when you're a start getting into the actual fun stuff, and that is what types of things can we deduct. So if you are starting a business, one of the things you can deduct is your startup costs. Now, startup costs of a business, that can be the money that you pay to a lawyer or the LegalZoom or anything else that you use to set up a business. But the other thing that it does is it lets you pay for things like the education and the money that you spend to learn how to trade. If you've spent money before you set up a company to learn how to trade, generally we can use that as an expense for the business when we set the business up. Other expenses that we can take, these are just a small list, and there's even more. So there's the startup expenses, there's organizational expenses, which is a little bit different than startup expenses, but basically money that you put into organizing the business, setting up the right structures, modifying things. Any equipment that you purchase, this is electronics basically that you put into your business, such as your computer, your monitors, the TV that you're watching, Bloomberg on while you're looking at the trades and looking at the markets. Okay, automobiles. If you do it right, we can take mileage from when you're driving around. Now, you've probably seen people when they slap on, they slap on something on their back window that says the type of business they have. That's not necessarily what I'm talking about. Trading's a little bit different, but there are times that we can deduct mileage. Contributions to retirement plans. If we set stuff up right, you can make contributions to retirement plans and have those be tax-free. Life insurance, money that you pay for that. A huge one is also travel and the meals that you have, food expenses. This can be eating out at night with people that you know if you set it up right. Travel, when you go to visit family and friends, or you go on a vacation, if you set it up right and we do things the proper way and you take the proper, you do the proper documentation and you really make it a business trip, then we can deduct those things. It's really, it can be really exciting. One other type of deduction that we can take that I do want to point out, sometimes it depends on the type of entity that we create to see what you can take as a deduction. A C corporation is, there's different types of corporations under the tax code. There's S corporations and C corporations. C corporations can take medical reimbursement plans. So as many of you know, just in your normal taxes, if you have medical expenses, you can deduct those on your taxes if and only if they're over a certain percentage of your income. Now that's changed even now a little bit because under the new tax code with Trump, we've had a few, they've increased the standard deduction that people can take. Medical expenses, they have to be over a certain percentage and it's going higher to be able to take those expenses. If you have a C corporation, you can actually take medical expenses through the C corporation and count them as a deduction. Now, there's a lot of different types of entities, okay? So I'm going to want you to talk to somebody before you go and set one up because we want to make sure that you set the right one up. C corporations aren't right for everybody. They are right for some people. Now, if you want a copy of the type of expenses that you can generally get because you want to look them up or you want to get an idea of how they would apply to you, go ahead and email learn@tradersaccounting.com. Again, that's learn@tradersaccounting.com, just like it is up on your screen. Put expense sheet in big capital letters in the subject window, and we'll send you the type of expenses that you can take. Now, there are different types of entities. I'm going to touch on these really quickly. Okay. There are 4 different types of actual entities that you can set up under a state's law, but they are taxed differently under the federal tax laws. Okay. So the first thing that you can do is set up as a normal active trader that's just an investor. Okay. And if you do that, you're considered to be a sole proprietor. And that's the very top one that we have here. Now, like I said, someone who doesn't actually have a business set up, they can take deductions. That's okay. But like I said, that triggers audits all the time. And so a sole proprietor, that's when you don't set up a company, but you do take business deductions, frequent audits. There isn't any asset protection. Again, we're not going to get way into that, but there's no asset protection. But that's a big problem, is the frequent audits and then being classified as a hobby. LLCs is the second type of entity that you can set up. An LLC is actually really flexible. We can have it be taxed as a sole proprietorship. We can have it taxed as a partnership. We can have it taxed as a C corporation, or we can have it taxed as an S corporation. So it's actually really cool. We can have it taxed however we want. Now, generally, you'll see in the con section here, we need 2 members to do a tax return. Generally, the way that's best for an LLC to be taxed is for us to have 2 people there. So to set up an LLC is what I recommend for most people, and generally I recommend that you have 2 people. Now, this can be a husband and a wife. It can be a father and a son. It can be you and your mom or your dad. It doesn't matter. You just need to have 2 people. And we can split the ownership. It can be 99% owned by one person and 1% owned by another person. It doesn't matter, but we generally do need to have 2 people. Okay. C corporations, like I said, we can deduct medical expenses, which is really cool. C corporations also sometimes have a lower tax rate than individuals. Some of you out there that do know a little bit about tax will say, well, C corporations probably suck because you get double taxed once you pull the money out again. That's actually not necessarily the case with the C corporation if you set it up right. There's some cool things that we can do after you've owned the C corporation for a number of years, where we can sometimes get the money back out tax-free. So for people that are higher earners, sometimes a C corporation makes a lot of sense. Finally, and last, is an S corporation. S corporation, they are generally an awesome entity for businesses, but trading is a special type of business. So we generally don't use it for trading. Now, there are times that we do, but we generally don't. Again, it's usually an LLC that we set up. Before any of you guys go and get anything done, do call, get a free consultation, talk to Raven. Let's figure out which works best for you. Because, again, there's lots of different ways that we could set you up, and it really kind of depends on how much you're making, how much you're trading. But as long as you are actually trading and you actually are making money, it generally makes sense for you guys to be trading out of a business entity. Now, one thing that does come up a lot and might actually pop up is, where do I set up my business? What state? And if you guys look out on the internet and you actually look stuff up, you're going to find tons of stuff, especially for Nevada. Nevada comes up all the time. Okay, you're going to find stuff for Delaware, and you might even find stuff for like New Mexico. The thing that you need to realize is that a lot of these states are not as good as what they advertise. And further, when you actually have a business, you have to have the business registered in the state in which you are working. So if I am licensed in Utah and Arizona. So if I have a business that I'm setting up down there, if I set up a Delaware company, but I'm running it out of Arizona, I need to register it in Arizona. And registering it in 2 states costs more money, and it also takes away the advantages that one of these other states might have. Okay, so generally when we set up a business, it's going to actually be set up in the state that you live in. That almost always makes the most sense. Again, there can be some exceptions to that, but they're very rare. If you've heard something from your uncle about why you should do it in one of these states, to be honest, they're probably wrong. But again, call us and we'll talk to you about it. Now, there's a few other things that do come up. Some really complex things that we can do when you set up a business that can be really, really cool. One of those things is the mark-to-market election. And I'm going to get into that in a second. But one of the things that the mark-to-market election does is it gets rid of wash sells. Now, I'm going to read the wash sell law. I'm actually going to read it right off of the slide so you can follow along with me, but then I'm going to put it into normal everyday language. So bear with me. I just want to give you an idea of kind of how this flows with the tax code. Okay. This allowance of loss deduction in the case of any loss claimed to have been sustained from any sale or other disposition of shares or stock or securities where it appears that within a period beginning 30 days before the date of such sale or disposition and ending 30 days after such date, the taxpayer has acquired by purchase or by an exchange on which the entire amount of gain or loss is recognized by law, or has entered into a contract or option so to acquire substantially identical stocks or securities, then no deduction shall be allowed under Section 165 unless the taxpayer is a dealer in stock or securities and the loss is sustained in the transaction made in the ordinary course of such business. For purposes of this section, the term stock or securities shall, except as provided in regulations, include contracts or options to acquire or sell stocks or securities. Fantastic. Basically, what this really means in normal everyday terms is if you sell a security and in the next 30 days, if you purchase that again, they're going to pretend that you never sold it in the first place. Now, why do they do that? Let's say at the end of the year, you see a stock that you have and you have a big loss on it, and you think that it's going to go up. So instead of holding, you just simply sell the stock on the 31st of December, and then for that year you capture the loss on your taxes, right? And then the next year you purchase at that lower price, and then you take a gain because it goes up just like you expected. The IRS says, hey, no, you're cheating, okay? And they won't let you take that loss. Now, there's certain things that we can do, like the mark-to-market, where we actually get rid of this rule. It takes it away, so it's not something that you actually have to worry about. It's actually pretty cool. Now, we're going to cover mark-to-market. It will probably be covered in another webinar. It's pretty complex. I will throw out one more thing for those who are super interested in mark-to-market. Generally, we do an election for someone who wants to take mark-to-market after they set up a company. Once you set it up, you have about 60 days to make the mark-to-market election, okay, with the IRS. So we set it up, we file with the IRS that we set up a company, and then we say, oh, by the way, we want to take the mark-to-market election. That gets rid of wash sales. So that's a huge thing for a lot of people, and that's one thing that a lot of traders care a lot about, is these wash sales. However, another huge advantage of mark-to-market, and again, if this doesn't make sense, hopefully we'll talk about this again in the future because this is a little complex. But if you take the mark-to-market and you're trading certain types of stocks, if you have a loss at the end of the year, we can actually change your loss from a capital loss to an ordinary loss. Now, I'm not going to go into what that means because, again, I'm getting really into the weeds, but let me give, for those that understand what I'm saying, basically what it does is it means we can take the money that you lost and we can apply it against any normal gain that you had that year. So, for example, if you have a job and you make 50 grand in your job every year, well, if we have a loss when we do the mark-to-market of 10 grand, 20 grand, you can actually take that against the income that you earned from your job. So instead of making 50 grand, you have a $20,000 loss, you only made 30 grand for the year. Again, most trade, you only get to take a $3,000 loss. Okay, this mark-to-market changes that because we're changing the type of income. Again, I know I'm getting into the weeds, so I'll jump off of that. But for those of you who want to know more, this is a huge advantage that you can do when you set up a business. It's really cool. Now, I'm going to talk about, real quick, when it comes to trading and it comes to doing taxes, it is important that you work with an accounting firm or with advisors that actually know how to deal with traders. Now, if you remember at the very beginning, I mentioned that trading is different from other types of businesses. Okay, there are a lot of great CPAs out there, and there are a lot of CPAs that know how to deal very well with businesses, and they're incredible business accountants. Very few of those CPAs, even the ones that are fantastic, very few of them know how to deal with traders. Okay, and that's because there's a place in the tax code, it's section 1402. Again, I always get a little bit too far in the weeds, but under section 1402 of the tax code, trading is exempt from active income, meaning that even though it's an active thing that you're doing and you're making money, you don't have to pay self-employment taxes, for example. That's one thing. And there's some other things in the tax code that are different than the normal business. Okay, so if you're going to be doing a business, it's almost always correct to go and hire a business accountant. But again, you really want one that focuses on trading. Now, the reason for this is it gets a little more complex. If you have a business, you actually have to file a business return. And the business return has to generate documents that flow over into your normal everyday return that you have due on April 15th. Okay, so you have a return that's due on March 15th, which is the business return, and you will pay a little bit more money because you have to put a business return together, and then that's going to generate a document that's going to go to your normal return on April 15th. Again, the money is generally well worth it because if you have a good accountant, you're going to be crushing it when it comes to saving money and taking the deductions. Now, I really recommend, obviously, that you guys go ahead and you take the chance to talk to somebody over at Traders Accounting if you're interested in this idea. Again, it's a free consultation. You get it for 30 minutes, and they can tell you whether they think it's worth it for you guys to check it out. The number for that is 1-800-938-9513. Again, it's been on the screen the whole time. And also, if you look down in the chat section, you'll see that there's a link. You can actually click on that link, and it will take you to a place where you can just sign up for a consult. Again, you guys will be able to see if you're going to be able to save any money. We can talk about deductions. You can talk about the type of business is set up. We'll be able to answer those questions. So, thank you guys very much for letting me come tonight. Thank you, Steve, for letting me come and present. Again, please take advantage of the consultation. And now I would love to go ahead and answer some of the questions that come through. So I'm going to look down through. I saw some questions that did pop up in the general chat while I was talking. So I'm going to run through those. And people, if you want to, for those of you out there, if you have more questions, go ahead and throw them in there. And I'm just going to run through them and see if I can answer those questions. Okay. Someone asked, what's the advantage of mark-to-market or disadvantage? I talked a little bit about that, but basically the biggest advantage is getting rid of wash sales, and then usually an advantage for a lot of people, especially if you have another job besides trading, is being able to take your capital losses as actual ordinary losses. And again, what that means is you can take the money against your ordinary income or income that you get from the normal trading that you do. Now, if you're a trader that only trades and you're doing this full time, number one, way to go. That's awesome. Number two, mark-to-market, besides the wash rules, tends not to be as advantageous, but it can be advantageous, especially if you're savvy enough to be paying attention to the wash rules. Also, the question was also from Todd that asked the first question. Todd said, can I roll existing equipment I previously owned into a new business? Yes. The answer is yes. There are limits to the types of deductions that we can take when we do it, but we can. And if we run out of the deduction, so when we start a business, we're limited to $5,000 in upfront deductions for things that we're bringing into the business. But once we put it into the business, if we are not able to deduct it, because technically we actually sell it into the business. You said roll existing equipment. Technically we sell it in order to take the deduction. But that's neither here nor there. It doesn't really make a difference. If you have it there and it's more than $5,000, then we can actually deduct it over a period of time. We can do what we call amortizing that equipment. Now, Frank asked, what happens if there's one person in an LLC? Frank, if there's one person in an LLC, we can do a few things. Generally, they're considered to be a sole proprietorship. So you can set up the LLC, but it doesn't exist for tax purposes. So there's people that will set up an LLC, and if they don't do it right, then they don't exist for tax purposes, and they can go ahead and take the deductions that we talked about, the business deductions. And if they do that, then they're throwing a red flag for the IRS. So you really want to set up the LLC right. Now, you can set up an LLC and have it taxed as a C Corp or an S Corp. Like I said, that really depends on what you're doing. For most people, the S Corp option is not the right option. And for a lot of people, the C Corp option, it really depends on how much money you're making. In some instances, we even combine entities where you would set up an LLC and have it owned partially by a C corporation. Again, it gets pretty complex. Now, if you don't have anybody else who can be the other person on your LLC, because I want you to have two people, we can do some things about that too. Okay, we can find someone that you mostly trust and give them a very small percentage, and then we can put the money that you make as a loan to the business. And again, I'm really getting into the weeds here, but that will basically make it so that the money you make pretty much just comes back to you, even though they're on the LLC name. The other thing we can do is set up a trust. It's a simple trust. It's not that expensive. We set up the trust to be the second member, but it has to be the proper type of trust. Most trusts that are created out there are not the right kind. So again, you want to talk to the right accountant to see what will work for you. But if you're somebody that doesn't have somebody else that you can think of, we can still get you into an LLC and get you the right tax. We just have to do a little bit of planning. Diana asks, what is the tax impact for people trading in their IRAs? Diana, that is a great question. Retirement accounts in general, they can be awesome for trading. So if you have money in an IRA and you're trading and you're getting gain, generally, and I say generally because this is a very deep topic and we can go 50 ways from Sunday, but basically, if you're trading inside of an IRA, the money that you're earning is tax deferred. So you have 50 grand inside of an IRA, you're trading and you're making money on it year after year. You don't have to pay taxes on it year after year. You only have to pay taxes when you pull the money out. And you only have to pay the taxes that will count as income when you pull it out, but it's only on the money that actually comes out. Now, for those of you who have a Roth IRA or a Roth 401k, if you are trading in those, tax-free 100%. It's really cool. So if you're trading there, you can be making money hand over fist, and you don't have to pay any taxes even when you do pull it out. So that's a great question for those of you trading inside of retirement accounts. Frank threw out, he mentioned Wyoming. Lee mentioned Delaware as different places that people mention. It's great places to open businesses. You're right. They do have, just so you guys know, these places can have good laws. But again, most states require that when you set something up, you register it in your own state. And some people miss that. So there are states out there where we can get around that rule. It's very, very rare. And generally when it comes to trading, the advantages of setting up in another state like Delaware and Wyoming, they really aren't that advantageous at all. By the way, I'm just going to throw this out there. Nevada is not the best state to be setting stuff up in, and neither is New Mexico. Those come up a lot. Just be really careful, guys, when you're talking to people about how to set this stuff up and set up a business. There really are a lot of people that don't know what they're talking about out there, or that can make an argument and it sounds fine, but they're missing the other half of the argument. You really should mostly just be setting things up in your own state. Again, if you have more questions about that, just give us a call. Mr. or Mrs. Smith asked, what about trading through apiary fund? Call us. We'll talk about it. Steve asks, is it too late to take mark-to-market for the calendar year of 2018? For the entire year, I think we might have passed it. I don't remember off the top of my head if it was 60 or 75 days. But that being said, it's not too late to make it going forward. So if you start a business, you can do it now and take the election now and going forward, and you can get it for most of the year. Okay, so if you set up a business, it doesn't matter when you set it up. You can take the mark-to-market election, and you can take it from the day that you set up the business. So you can do it for the rest of the year. So if you guys are interested in that, again, give us a call. But realize that it's not too late to use it for this year. Now, I don't know if we can extend it all the way back. Probably not, because we actually have to set up your company. But you can definitely be using it for most of 2018 because we're barely through 2 months. Now, Tom, thank you for your validation. I really appreciate it. And Tom, I do agree with you. It's true. You do need to be really careful with who you hire. Again, there are a lot of great CPAs out there. You really want someone that knows trading. Just for an example, let's say somebody is trading and they're trading in an LLC, and you've got a business next door. You know, someone's running a dry cleaning business. You can both be LLCs and you can both be taxed the same way. So you can be making money, and the tax is going to come in on a partnership return. The partnership return is going to generate a K-1, and the K-1 is going to go on your normal taxes. And it's going to be the same for you and that dry cleaner. However, the way that it is reported on your personal taxes after it comes from the K-1, it can be on the K-1 say the exact same thing. In other words, that's the exact same amount of money. So you can make a certain amount of money. Just say you make 20 grand. The dry cleaner next door can make 20 grand. You can both have it on your K-1. But when you bring it in, it's taxed differently. Okay, it gets treated differently. And a lot of CPAs don't understand that. So if you set up a business, if you don't do it right, you might end up paying a lot more money. Steve asked, when do you have to take the election for 2019? I believe you're talking about the mark-to-market election. Again, we can take that whenever you decide to start the business. So now if you have a business that's already started, then you have 60 days from the beginning of the year to go back and take that election. Okay? Again, it might be 75. I need to double check on that. But call us, we'll let you know. I don't remember off the top of my head, unfortunately. 60 to 75 days. So if you have an LLC set up, you need to be taking it right away. That being said, again, generally we can take the election from the day that we take the election. So for you guys out there that want to set it up and want to learn more, again, give us a call. Use the link that was posted by Becky down there at the bottom, and we'd love to talk to you guys. So thank you very much, everybody, for listening, and thank you very much, Steve, for letting me be here. I really appreciate it.